Hello, everyone. Welcome back to Policy and Profits with a somewhat heavy heart. I'm alone today. My partner, EJ Antoni, as some of you may know, has been nominated by the President of the United States, Donald J. Trump, to head the BLS and fix the mess of what has gone on there. So I am very pleased with that as a U.S. citizen and as a friend of EJ. I'm very upset with that as a co-host and somebody that gets to talk to him a lot more in the past than I have recently. EJ, I'm sure, will do a fantastic job there. He is super intelligent. He is one of the best men I've met as far as character, as far as intent. And I think that he is more than capable of fixing the issues at the BLS and thus helping the U.S. move in the right direction as far as economy and as far as what this administration is trying to accomplish. So I am here alone. I'll try not to be too boring, and I wish EJ all the best, and we'll continue to keep you all up as I hear more from him from the DC area. What I'd like to do today is really focus on the markets. There's been a lot going on. This morning we had Chairman Powell, one of my favorite people, out in Jackson Hole, which has been a place for him to kind of make massive statements. I remember back in August of 21, he started with the destruction of that bear market, that bull market, made comments about rates going higher. And that August, we were down about 5% in the following month. And then on the turn into 2022, headed down about 27%. He used today to kind of backtrack, in my opinion, some of what he's been saying about there is no room for rate cuts. He is data dependent, all the great things. And he kind of left the door open for the potential for cuts, whether he referenced slightly weaker labor market, or economic concerns as far as growth, or the fact that inflation doesn't look as bad as he had thought it would be, and we're not seeing tariffs push through the system and create another wave of inflation coming. He left the door open. So what did that produce? That produced a move in the market of up over 1.5%. S&P futures right now up 1.5% at 64.83. That's on the front month, the SEP futures. We here are going to be looking at the S&P cash. It's an easier analysis. We don't have to deal with roll and term structure and all those things. So if we look at the market where we are right now, we're up around 6,400 right now on S&P cash. We're actually at 64.66 currently. I pulled this chart last night, so bear with me. The 2021 to 2022 bear market has been one that I've referenced many times. Referenced it because I felt like that was the beginning, that end of that bear market was the beginning of the AI narrative. That kind of pulled us out of that bear. What led us into that bear was Powell on a rate hike spree, which was completely unexpected. That created a regional banking crisis. You guys remember SVB, Silicon Valley Bank, went under because of the mismanagement of monetary policy and the misguided promises by Powell, which should have never happened, but did, of lower forever. And then we had Ukraine-Russia, right? So we had Ukraine-Russia, the 21 turn into 22. We had Powell starting to spike rates when he wasn't going to. And then we have a 9-month bear market. So that 9-month bear, you can see this chart, red vertical line is January of 22. That's when we hit our peak. And the green vertical line, October of 22, is when we bottomed out and started to rally. That was a 9-month period of a 27% drawdown. Pretty uniform. There were some concerns with China at the time as well with commercial real estate. We kind of took some air out of the bubble there. That was fine. That move higher started with the AI narrative, and it became a very narrow breadth market, which is still what we see. And that Mag 7 market, the mega cap tech names starting to explode out. NVIDIA became a name that people actually cared about back in the beginning of 22, was not the NVIDIA of today. And then the usual suspects, the Teslas, the Microsofts, the Apple, the Amazon, the Google, and such. That move higher brought us up to the next red vertical line, which was February of 25. As we got to that line, you remember back in December, January, I was talking a lot about a breakdown in longer term technicals. These charts, by the way, are the monthly charts. So if they don't look like your daily chart or what you're looking at day to day, that's why. Started talking about the longer term breakdown. So while the daily signals were buy and sell pretty uniform and pretty normal, I started to see that the intermediate and longer term charts were breaking down. December, January into February. So the call, I was a little early, but well timed, missed a lot of the downside as far as losses, and was able to make a good amount of profit for the fund on a short, flat strategy moving forward through that bear. And then that green vertical line just 2 months later was the bottom, down 21, almost 22% on the S&P. So peak to trough, we're talking about a move which was more of a shock move in 24 to 25. Or early 25, late to mid 25. So February 25 to April 25. And a longer term bear in the 21, 22 area. So similar moves down in magnitude, but very different in timing, very different in process. And that's important because the shock that we saw in 25 recently rebounded very quickly. The S&P right now is up 34% from that low just since April. I mean, we're only in August. This has been a massive run up in the index, a massive recovery, extremely quick. And I'm linking these two markets together because I feel like we're still within that same move. So the next chart that I have up, now that we're talking about the magnitude and the duration of these drawdowns, are they linked? So this is all, by the way, it's very pretty simple price analysis. Just kind of looking at things a different way. Well, if we look at the peak, and this is really interesting. If we look at the pure peak, forget momentum, forget trend, forget everything. The peak in January of 22 was 48.18 on the S&P. You can see that highlighted. The low in of April of 25 was 48.35. So if you're looking to connect these two markets in this tight time frame, right? It's been a couple of years. We're in what was looking like the second bear within that 5-year period, which was significant, but it held. Where did it hold? It held right at the peak of the previous bull, right? So what we're saying is that previous resistance on that 21 bull became support for the 25 bear. I like this connection. I think on price analysis and just simply looking at where the market is finding supply and demand, the levels are starting to match, and they've matched from the 21 to the 25 period. We're right in the thick of it. So if we go one step further in a simple price analysis, and we forget momentum, we forget trend, we forget, the Ascalon 6 momentum trend model, and we forget my spot VIX model and VIX term structure, we put everything to the side. We looked simply at price, and we can agree, which I believe, these markets are still heavily connected in a tight time frame, right? A normal cycle is about 10 to 12 years. We're talking about a 5-year period here. So we've tightened that duration. I think we're still in the same market. And if we go to the next slide and we look at, well, where do we go from here? If it's the same market and we saw a shock and not a bear market in 25, a quick snapback on what you could say is headline news, right? There was tariff concern, there was inflation concern, there was some geopolitical risk that took place with Israel, Iran, and Israel, Gaza, and all. But if you just look at the market action, where do we go from here if these markets are connected? Well, if you run a Fibonacci extension from that low in 22 to the peak in 25, you can extend this market up easily to 7,100. You probably could push and say that we had room to 7,200. So the 7,186 level is right around 123.6%. I think that's a pretty fair level. I think 7,000 is a really fat target to the upside. I've been calling for 6,600 as we break back up into that uptrend channel, which we recently gapped down out of. I've been writing about that in my morning report. But just roll back all that for a second. I think at this point, we can connect the markets from 21 to 22. And I think we can extend the move up and kind of get a fit for or a feel for where we might go. I think if we can maintain, and again, this is weak breadth, the valuations are high. You can go through all the fundamental analysis you want. You can look at technicals longer term. They're so-so. They're really evenly skewed upside to downside. But if we think that the market has some legs and we think these markets are connected, healthy or not, markets will grind higher. We know that. Technically speaking, and I love to hate them. I'm going to be very clear. I'm very happy being short, but I'm happier making money. If we could break out above the previous high here and have survived the recent geopolitical risks and the recent risk of no rate cut, whether or not that makes sense, that's what the market's looking at. If we can have survived those risks and break to a new high off of our recent high on this stick, on this month, I would definitely mark our upside target at 7,000 to 7,100 very easily. I think that that's an achievable target. I'll be watching trend momentum as we make that move, but I am pretty confident here that if we can break to new highs, whether it makes sense or not, and I'm being very honest, fundamentally, it does not make sense to me. Internally, it does not make sense to me. But if I look at my model and I look at the technicals, it is a real possibility that we can get to the 7,000 level in the intermediate term, meaning potentially by year end into first quarter of next year, we could be seeing a real move to 7,000. So there's a lot of reasons to be skeptical. I am more than happy to be skeptical. Like I said, I love to hate them. Not a perma bear, but I'm very comfortable in the bear position. But I like being profitable more. And at this point, to be objective, I would connect that 21 to 22 market. I would connect that with the 25 market we're in. And I can show you and did show you why that makes sense. Basic price structure, basic price action. We can extend this move up to 7,000. I think with a bit of ease, especially if we see some cuts coming out of the Fed. That's kind of today's episode. That is today's episode. Be aware of the risk and the skew. My daily report is out on X at CMT_Anthony. You can also go to Ascalon6capital.com. That 6 is Roman numeral, AscalonVICapital.com. And you can see the report there. You can see a archive of reports there. I do write on the S&P every day based on market internals and based on the ACAP process. And I'm more than happy to share that information on X and on the website. Thank you guys. Have a great day. Talk soon.